Hi, I'm Max Keiser, and this is the Keiser Report. Markets, finance, and scandal. Let's get right into some of the big headlines this week with Stacy Herbert.
Max, it's good to be here. I've got a big headline for you just to set the tone of their overall show. Bailout buffet. Leading financial reform proposals won't end taxpayer protection of Wall Street. I want you to note the word protection because we know it's a protection racket run by these mafia dons on Wall Street.
Well, that's basically true, Stacy Herbert. You've got a protected group of market manipulators that have insulated themselves from any prosecution by the law, and it's very hard now to break into the racket.
The first headline is revealed Goldman Sachs made fortune betting against clients. Of course, everybody knew this and everybody has been charging Goldman Sachs with doing this, and Goldman Sachs has denied it. But according to the chairman of the Senate's Wall Street Investigations Committee, who released documents, all the emails, internal emails from Goldman Sachs, it turns out that, lo and behold, Lloyd Blankfein had emailed colleagues, quote, "Of course we didn't dodge the mortgage mess. We lost money, then we made more than we lost because of shorts," which of course are bets against the market.
Right. Well, Lloyd Blankfein likes to claim that this asymmetric trading is adding to liquidity somehow, which is a buzzword for fraud. And you see, Goldman Sachs, in the land of the blind, the one-eyed man is king. And he's simply saying that, oh, it's a profit. Oh, it's a loss. No, it's a profit. Depending on how you look at it, you can declare it's a profit or a loss if you simply fail to disclose the entire trade, both sides of the trade. And this is the problem. They don't disclose the entire trade. They only disclose part of the trade that they want to disclose at the time that they want to disclose it and claim that this is how they should be judged, not only on their earnings and on their market capitalization, which, as we pointed out in the last show, if their market cap were marked to market based on actual and implied fraud, it would be zero.
Well, more on that. Goldman's take no prisoners attitude. Mortgage division cast bets boldly, awaiting big one. So again, in all these emails that emerged from Goldman Sachs, there are dozens of bankers and brokers at the company who were like cheering, waiting for the subprime disaster to happen, including the fabulous Fabrice Torre, who in January 2007, he described creating a thing, quote, which has no purpose, which is absolutely conceptual and highly theoretical. He added, it sickens the heart to see it shot down in mid-flight. It's a little like Frankenstein turning against his own inventor.
Yeah, it's a Franken derivative. And one of the key points there, Stacy, which is an interesting point people should understand. In other words, they're waiting for it to collapse. While they're waiting for it to collapse, they engage in the parlance of options traders, which I was an options trader on Wall Street for many years. You're putting on basically a straddle, which is you're putting on both a call and a put. You're putting on both sides of the trade. And you're essentially buying volatility in this sense. And all you have to do is sit back and wait. It's either going to collapse or it's going to make a move in the opposite direction. In either case, you're going to be making money if you have an outside the range of normalcy move, which is guaranteed if you're packaging into these securities toxic waste that's guaranteed to blow up. And now what's remarkable about Goldman's situation is that they also, because these are income-producing properties, are using the income to pay for the straddle, essentially. That's one thing that we never had during my time on Wall Street. We didn't have the derivatives, weren't sophisticated enough to engage in a fraud where you would be paid to wait for your straddle to make you money. This is really a new thing. It makes me kind of, homesick for Wall Street because all you do is sit back, you play cards all day, drink sake down at the sushi bar, wait for the market to explode, which is going to explode because you put the explosives in there and lit the fuse, and you collect your Christmas bonus.
Part of the charge of them committing fraud is that they knew these things were toxic and they were going to blow up. So I just read to you an email from January 2007 where he says, it's a theoretical and highly conceptual, and it's a Frankenstein derivative he's created. 6 months later, in June 2007, Fabrice Torre sent another email to a friend when he had just landed at the airport in Belgium, where he said that he managed to sell, quote, a few abacus bonds to widows and orphans that I ran into at the airport. So he's there bragging that, of course, widows and orphans are famously the passive investors.
The suckers.
Mr. Torre, this sounds like a deliberate strategy to sell products, complex products, to less sophisticated clients.
I think what I was expressing in that email was that with respect to ratings-based clients, they had a tendency to, argue less about, bid-offer spread than hedge fund clients.
That's right. The pension funds, the large pension funds, for example, CalPERS, the California Pension Fund, which is the biggest in the world, is where a lot of banks just throw a lot of risk into those funds to dump the risk. They become toxic risk dumps, the pension funds.
Yes, well, CalPERS was famous for buying billions, tens of billions of CDOs from Bear Stearns literally weeks before it blew up.
Yeah, well, we advised them not to. But they did anyway because they were yield chasers. But, on this point of the toxic debt that is just being dumped into the market like this and the widows and orphans that are getting screwed. Remember, back during the Enron days, the Enron traders were bragging about how they were turning the lights off in California. And all the widows and orphans and grannies. I think the grannies are going to freeze to death in California because of the fraud related to Enron. And then we had Sarbanes-Oxley, but then Wall Street just did an end run around Sarbanes-Oxley, and now they're bragging about, ripping people off and committing all kinds of financial chicanery.
Well, exactly. The last episode we discussed William K. Black, who testified before Congress regarding the Lehman collapse and the use of Repo 105, and he said this is the exact same fraud that was used in Enron.
Yeah, well, I see it's like Lloyd Blankfein. You see, if you just cover one eye, I can say, the world looks only two-dimensional to me, therefore I must give myself a huge Christmas bonus. Oops, oh, wait a minute, now it looks completely different. Am I colorblind? Am I shyster? No, I'm Lloyd Blankfein.
On the same topic, rating agency data aided Wall Street and mortgage deals.
Oh, they caught up to this, huh?
So the article starts out like this. One of the mysteries of the financial crisis is how mortgage investments that turned out to be so bad earned credit ratings that made them look so good. And of course, by them looking so good, the funds, the passive investors, the widows and orphans and their fund managers were able to buy these toxic debts. One answer is that Wall Street was given access to the formulas behind those magic ratings and hired away some of the very people who had devised them. So the rating agencies made public their computer models, their algorithms. They gave those to bankers. And the bankers were then able to tweak precisely how to make sure it was investment grade by just adding like little tiny fractions of a commercial bond that might be higher rated than all these junk bonds, the subprime mortgage bonds.
Right. So it's like the bank giving the combination to the safe to any crook that walks by. Moody's gives the combination to how these bonds are rated on their internal proprietary algorithms to anybody who's doing business needs to adhere to the regulations and the oversight of Moody's. So Moody's is complicit in this. They're part of the five fingers of fraud. The banks, the rating agencies, CNBC, and the two other ones that escape my mind at this moment.
Federal Reserve,
the Federal Reserve, Congress, yeah. The five fingers of death. They're all in on it. You need RICO. You need RICO to take them down. Otherwise, they'll just do this daisy chain of fraud where, one guy's turn one week and another guy's turn the next week,
And here's the final section is on Greece, and this is so fast-moving that it actually could be blowing up as we speak right now. But Greece nears getting aid, warns against default bets. So again, it goes back to betting against the whole thing you created. But Greece is warning investors not to bet against the country because they said, quote, you'll lose your shirt. But of course, it brings me to the very next headline that goes with this. Greece bond yields are absolutely exploding right now just before a bailout because, Greece has asked for a bailout from the EU and the IMF officially.
And they're telling the hedge fund industry, which has assets around $2 trillion and access to leverage of 10 to 20 times that, that their bond market is immune from the kind of chicanery and short selling and bust outs that the hedge fund industry has shown a proficiency at. That's just asking for trouble. It's putting a big bullseye on your back, a big kick me sign. Whoever said that in Greece should be fired immediately.
Well, there's 8.5 billion euros of Greek bonds which are maturing on May 19th. So everybody's worried because of, in particular, about Germany, because Germany still has to make it so it's legal for them to even give aid. Right now, it's not legal for them to give aid. But the IMF is there, and that's in the headline, Greece should not fear IMF. So this is Dominique Strauss-Kahn in America, and he said, quote, Greek citizens shouldn't fear the IMF. We are there to try to help them.
That's right. The IMF, you see, is like, the doctor. In this case, it's Dr. Kevorkian. Look, the IMF has a track record for allowing private corporations to come into your economy, privatize all your valuable assets, and force you to buy the milk from the cows that you just sold.
Now, on this final note on the IMF, from the rumor bag, the dangerous politics behind the Greek IMF bailout and why a government collapse may be imminent. So this is from the Greek press. It's a translation into English, and it appears that Papandreou is rushing to get a deal involving the IMF because the Russians were about to offer a 50 billion euro, no strings attached, 4% loan package to Greece. Furthermore, the Chinese were showing interest in purchasing the Greek National Railroad, a real bleeder for Greek public finances, as part of a 60 billion euro European shopping spree package. This is information that was published on a blog in Greece from a high-level official who's not yet quit. He says he's resigning from government.
Look, if the price is right, Greece is a great buy. It's a good place to park your yacht. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more right after this.
They destruct war memorials, take part in extremist movements, and exalt nationalistic leaders. Is history just a political tool in some leaders' hands? And why is society still strongly divided over whom to call heroes? Battle for History on RT.
Welcome back to the Keiser Report. Time to welcome to the show Max Fraud-Wolf. Max teaches economics in the New School University Graduate Program in International Affairs. He's also a blogger on the Huffington Post. Max Fraud-Wolf, welcome to the Keiser Report.
Always great to join you. Thanks for having me back.
All righty now, Max Fraud-Wolf, in a recent piece you wrote on the Huffington Post, it's entitled, The National Interest. Interest being the increasing amount of income going toward paying interest on debt. Talk about the balance sheet of the U.S. government. How big is the balance sheet? And do you see a Greek-like crisis on the horizon?
Well, we certainly could have a Greek tragedy. We have a few things going for us that Greece does, and not to in any way slight Greece, a country I love, I've spent some time in. But the United States can print its own money, and even though that has bad long-term consequences under the Euro system, Greece, as well as the other distressed, sometimes called Euro pig nations, can't do that. But the United States does have a bit of a debt spiral. Things are getting worse, not better, and we're looking at a situation where we might be spending 20% of our tax revenue just paying back our excess spending of the past in just a few years from today. So we do have a serious problem that's getting worse, not better, but we're not quite in the situation that we see gripping Athens and the nation of Greece these days.
All right, Professor Wolf, I have a question for you. I just thought of it at the spur of the moment. It's the question of, can the U.S. devalue the dollar? Because when it was on the last time it did against gold, of course, the U.S. was on a gold standard, but now we're on a fiat currency system. We're not on a gold standard. And I was talking to Mike Shedlock about this, and he was explaining that the U.S. technically could not devalue as such. Is it possible to devalue the dollar? What are the obstacles there?
Well, with a floating currency rate, we don't really necessarily use terms like revalue, devalue the way we used to when we had set currency rates before the 70s and 80s. But the United States could undertake a series of actions that would knock down the value of the dollar against currencies like the renminbi out of China, the yen out of Japan, or the euro out of the Eurozone, the British pound, etc. And in fact, we've done a lot of things which will in the long term push down the value of the dollar. But the dollar is still the basic currency in which oil is traded, a lot of commodities are traded, and we still have the world's largest speculative markets, and so lots of things about our economy create demands for dollars, and there's a final irony, which may eventually end badly, but the United States, the U.S. dollar, is still where you run when you're scared, and so if there's what Wall Street calls a flight to quality, people tend to rush into the U.S. dollar, and that pushes it up. We have a tug-of-war about the dollar between exporters and the financial markets. The financial markets tend to pretty much heavily prefer a strong dollar. Exporters, or the artists formerly known as exporters in our economy, preferred a weaker dollar, and they have, over the last 30 years, mostly lost that struggle.
Right. Exporters, of course, meaning manufacturing, meaning, of course, jobs, meaning, of course, wages, the backbone of the economy. And this recovery we've seen has been pretty much the result of a financial injection and no real increase in wages or jobs or manufacturing. It's been a bit of an ersatz recovery, and it's on very thin ice. The volume on these exchanges, for example, to get to these new levels is very, very thin. So as far as getting back to an export-driven economy, it seems like devaluing the dollar has to happen at some point, or the U.S. is going to be trapped in this vicious cycle of relying entirely on the financial sector, which is prone utterly to manipulation, insider trading, and market manipulation.
Well, we certainly have lost a lot of jobs. I would mention, I think your point is a good one, only it's not just that we haven't grown jobs and grown wages and grown manufacturing. Over the last 24 months, we've seen massive shrinkage in jobs, wages, and manufacturing. So it's not just not growth, it's actual shrinkage. So far, we've seen a real return of hope, and there's always some value to that. The worst days may well be behind us. And we've seen massive government stimulus, only we've seen a stimulus in spotty areas, so it's not been uniformly kind of put in. We have another 6 months of heavy stimulus in the pipeline, and the $64,000 question, right, that's the nail biter here, is how much of this recovery is a change in sentiment and pumping in a lot of government assistance with some return to profitability by big corporations, and how much of it is a real sustainable recovery with hundreds and hundreds of thousands of jobs produced in net every single month for a year or two, and return to balance in our households. And we haven't seen that second part yet at all, the jobs or the return to balance. We will get some job growth over the next few months, but it may end up being too little too late, even though it'll be better than losing jobs, which we did from basically December 2007 through basically last month.
Okay, when you mentioned stimulus, that brings us right back to the question about debt, because the government is simply going deeper into debt to try to fake it until they make it. So tell us, how much has the government debt increased since the financial crisis began?
About $2 trillion, on its way to $3 trillion total increase by the end of this year. That's $3 trillion with a T, so that's $3,000 billion, and it is an enormous amount of money. It means that the United States has an indebtedness greater than all of the Euro pigs that people like talking about, Portugal, Ireland, Italy, Greece, and Spain put together, a debt growth larger in the last 3 years, and we're looking at trillion-dollar-plus budget deficits last year, this year, next year, barring an unforeseen miracle in the budget.
Okay, so resolving the crisis, growing the economy, as we've just talked about, seems unlikely. So are we talking about raising taxes, cutting spending, austerity measures, or dollar devaluation? What's the most likely scenario?
Well, you may get a dose of inflation, which will reduce the total pain of repaying the debt. That's what keeps gold prices up in the world economy, makes people nervous that the United States might be on a long-term inflationary path, even though there's no evidence of inflation lately because of the weakness in the macro economy. But in the long term, we'll probably see renewed pressure on the dollar, with the one exception being if the bubble-like conditions in the developing markets explode, money will run back to the United States and push the dollar up yet further. And we have kicked the can down the road, and what we need is a sustainable and balanced structural shift in the economy. And so far, we've spent a lot of time and a lot of money mostly trying to put Humpty Dumpty back together again instead of building a new king for our economy that's not made out of eggshells.
Now, the Goldman Sachs, in a note to clients, says, quote, what is the right measure of U.S. government debt? They suggest that the U.S. debt numbers are not to be concerned with at this moment. Your comments?
Yeah, well, I mean, I think the U.S. government debts are probably less of a concern to lots of financial institutions than getting the support they're getting from the federal government, which has a hand. It's not the only determinant, but it has a hand in contributing to that debt growth. But on the other hand, if you look at it from the long-term needs of the U.S. society or the U.S. government's stability and balance, that might be a very different perspective than the one that the investment committee at Goldman Sachs keeps in its mind when it generates its reports and its letters to clients.
Of course, when you put the Fannie Mae and Freddie Mac onto the government's balance sheets, the debt number looks a lot worse than it currently is. Shouldn't the Fannie and Freddie be included in that debt number?
They should, and they would add somewhere on the order of $5.1 to $5.3 trillion, that's $1,000 billion, onto the government's balance sheets.
Right, on top of the existing, what is it, $12 trillion?
$12 trillion, about $8 trillion of which is publicly held, and the other $4 trillion is held by other government agencies. So we tend to take that less seriously on the notion that one government agency is unlikely to force repayment under nasty conditions on another government agency, although that is theoretically possible. And if you want to really take the all-in count on government debt in the United States, you should look at the total value of all non-funded liabilities, and then you get a government debt number that looks more like about $40 trillion.
All right, so all in, you're talking about 17, 18, 19 trillion dollars. The total GDP of the U.S. now, I think, is around 12 trillion. So certainly these are pretty astronomical numbers. Now, speaking of Goldman Sachs, the SEC case against Goldman Sachs, is this going to be justice at long last or just a show trial?
Well, it's a civil indictment, so for some folks who are out there with the pitchforks and the torches who wanted to see people go to jail, that looks fairly improbable in this. But I'd say this is the opening salvo in what will be a large number of cases. I think that significant damage may have already been done, not existential, but significant damage may have been done to Goldman Sachs already in terms of its reputation. This certainly isn't helpful. I also think you're going to see other agencies, both in and outside the United States, some states' attorneys generals, and probably rafts of investors sue. So if nothing else, this is the Securities Attorneys Full Employment Act of 2010. They should be doing quite well. And I think it's a little bit early to know exactly what comes of this, but I assume a lot of mudslinging, including in the congressional hearings from Blankfein and company, and some reputational damage, and probably some fines into the tens of millions of dollars.
I remember when John Goodfriend was caught up in the Salomon Brothers government bond rigging scandal. They had that great scene of him being frog-marched off the trading floor, and this word frog-marched entered the lexicon in a big way at that time. And I'd love to see Blankfein frog-marched onto, outside of 85 Broad Street, and thrown into the paddy wagon. We'll see if anything like this happens. Now, you're in New York where the criminal charges are emanating, and your state attorney general, Andrew Cuomo, what is he doing about it? Remember, Giuliani made a huge score when he went after Mike Milken in the 80s, and it was a great political boost for him. You're a resident of New York City. What about Andrew Cuomo? Is he going to step up and do the Giuliani thing and make some political hay here?
I think in fairness to Andrew Cuomo, although he's certainly not camera shy, he's slightly more subtle and a little bit less opportunistic in such cases than Rudy Giuliani. Then again, who isn't? I do think that every poll shows, and every casual empirical type measure one might take, that the financial sector of the United States is widely hated, is widely blamed for the downturn, probably much more than is macroeconomically correct, but nonetheless widely disliked. So there's enormous pressure on legislators. I think you'll see that in a relatively faster, smoother passage of financial reform. And I think Andrew Cuomo and lots of other states' attorneys generals and aspiring gubernatorial candidates are going to be all over Goldman and many other firms. Goldman was the fourth largest of the CDO issuers, which means that there's risk exposure there for Merrill Lynch or Bank of America Merrill Lynch now and UBS and many other banks as well.
Okay, so the financial reform bill is sailing through Congress now. You give him a good chance of something passing?
I think something a little bit tougher than would have passed 2 months ago, but maybe not as much as the most sort of strident regulatory desires. But something will pass, and I think it'll be fairly likely to be signed into law, fait accompli, by Independence Day here for July 2010.
All right, well, that's all the time we have for today. Max Fraud Wolf.
Thank you. Thanks for having me. Always great to join you.
All righty, and that's going to do it for this edition of the Keiser Report. If you want to send me an email, please do so at keiserreport@rttv.ru. I want to thank my guests, Stacy Herbert and Max Fraud Wolf. Until next time, this is Max Keiser saying bye, y'all.